Okay, so I want to walk us through the accounting for a defined benefit plan. I will probably break this down into 2 or 3 smaller videos, and when I put them out on Canvas, I'll indicate what order they should be watched. Let's walk through the assumptions first. We have a defined benefit plan. We're going to walk through 3 years of accounting for it. And the primary reason for that is just to identify different issues and will increase complexity. Here are the assumptions. In 2017, which is our first year, at the beginning of the year, the plan assets on the books of the plan were $450,000. The projected benefit obligation at the beginning of the year on the books of the plan was $450,000. So remembering the plan assets represent everything that has been contributed into the plan heretofore, plus any earnings. And the projected benefit obligation is the obligation we have to pay out should the plan end today and we have to pay everybody. Then for the year 2017, we incurred annual service cost of $27,000. We have a settlement rate, which is the discount or interest rate for the liability. This would be the rate that's being used for purposes of present valuing the PBO, projected benefit obligation. The actual return on the plan assets for 2017 was $30,000. We contributed into the plan $32,000, and the plan paid out to retirees $17,000. Okay, so those are our assumptions for 2017. So in terms of determining the journal entry that we, the company, have to make on our books, we're going to use a worksheet, a pension worksheet. And I've already put it together for 2017, but I'll walk us through it. You will notice that columns C through G are headed up general journal entries. So it's these columns that actually appear, are accounts that appear on our company general ledger and that will generate the journal entry we record. Columns J through L are entitled memo record. These items are actually on the books of the benefit plan. So the projected benefit obligation, the liability the plan has to pay out to the beneficiaries, the plan assets, the investments that are there. What we're doing here by including both sets of books, if you will, on this worksheet is relating our calculation for our journal entry to what is reflected on the plan's books. So in row 8, we have balances for January 1, 17. There are no balances in our general ledger items. Annual pension expense, there would not be. Pension expense is a temporary account. It'll start over each year. Cash, obviously, there is a balance in cash, but not related to specifically related to this entry. This pension asset liability account is an account that is carried on the books of the company. The title, as the title indicates, it may be an asset, it may be a liability. It depends on these items because what FASB has said is you have a projected benefit obligation, how much you would owe your employees if you closed the plan today. You have plan assets, which will be used to pay those employees. Theoretically, at any point in time, those should be equal. In other words, we should have enough plan assets to pay our obligation. In truth, for most companies, they're rarely equal. So what has happened is FASB says if your liability and your assets on the plan books do not equal, that means you're overfunded or underfunded. So in other words, if our plan assets exceed the obligation, then we've got more assets than we need to make payments, which means if we closed today, the plan would actually owe us money back. And so FASB says you need to record that asset on your corporate books. In contrast, if plan assets are less than the projected benefit obligation, then we are underfunded. In other words, if we closed the plan today, the plan would not have enough assets to make all the payments. The company would have to pay into the plan more monies, i.e. they would have a liability on their books. So effectively, FASB says any underfunded or overfunded status in the plan must be reflected as an asset or liability on the company books. January 1, 17, we're in that rare situation in which the PBO and the plan assets are equal, so there is no need for a pension asset or liability on our company books. Okay, so let's calculate our pension expense. You'll notice under items, you'll see a line item for service cost, interest cost, and actual return. If you remember from the other video on the PowerPoints, those are the three items that are always going to be included in your annual pension expense. All of these come from the assumption page. The service cost comes from the annual service cost for 2017. The interest cost is a calculation that is the beginning balance of the projected benefit obligation times that settlement rate of 7%. And that is, you'll notice the debit indicators here, that's because both of those are increasing pension expense, which would be a debit. And then you see the actual return of $30,000, which comes off the assumption page. That's the return that was earned by the plan assets. Now, notice what I've done here. I debited service costs to the annual pension expense. Well, that pension expense service cost also increases the projected benefit obligation. So while it's debiting annual pension expense, on the worksheet, we're acknowledging that that will be a credit on the books of the plan for $27,000, increasing the obligation. Same thing with the interest. We're debiting, increasing our annual pension expense, but we're acknowledging that on the books of the plan, that will also increase the projected benefit obligation. Lastly, the actual return is decreasing our pension expense. Remember from the other video, any earnings that the plan has will reduce our cost to the plan. So that's a credit, and you will notice we're acknowledging over here that on the books of the plan, it's actually increasing our plan assets. We're debiting our plan assets. Okay? And then down here, we come down to a grand total, which is actually the service cost plus the interest cost minus the return. And this says in 2017, we need to record $28,500 in pension expense. Okay. Now, the credit to cash represents our contributions into the plan. And so again, that's going to come from the assumption page that was given to us. And you will notice that's a credit to cash that we will need to record. But over here, we're acknowledging that on the books of the plan, it will be a debit increasing the plan assets. And then lastly, we have a line item for benefits. Our benefits don't affect us. The payment of benefits doesn't affect our general ledger at all, notice. The payment of benefits is purely on the books of the plan. It's a debit to the liability, and this number comes from the assumption page. It was given to us. It's reducing the liability because we're meeting part of our obligation, and it's reducing the plan assets because we actually took cash and paid it to our beneficiaries. Now, let's come down and see what we have here. Notice that after all those entries are taken into consideration, the ending balance of the projected benefit obligation is $491,500. After all of the adjustments to plan assets are taken into consideration, the ending balance in plan assets is $495,000. We are now in an overfunded position. This number is merely the difference between the two. We have more in plan assets than we do in liability on the books of the plan. Therefore, we have a pension asset now on our own books. And we can prove that by taking the difference between our pension and expense and our cash. So the journal entry that we would record in 12/31/17 is a debit to pension expense for the $28,500, a debit to pension asset liability, in this case it's an asset of $3,500, and then a credit to cash of $32,000. And that's going to be our journal entry to record our pension plan for 2017. Keep in mind, all we're doing here is looking at this from the perspective of the corporation, not the perspective of the plan. We have to consider what's going on in the plan because of our requirement to record any overfunded or underfunded status on our own books. But these entries in columns J and L are being made by the plan administrator onto the books of the plan.